This chart tracks the Philippine peso in early 2026. In May, it shattered historical floors, hitting 61.75 to the dollar. Layered on top is the Consumer Price Index, showing inflation rocketing to 7.2. The World Bank recently slashed the country's GDP growth outlook to a concerning 3.7%. To protect your capital, you must filter out the noise of Manila's political drama. The only thing that matters now is the macroeconomic signal. The first clear signal is energy. The Philippines imports over 95% of its crude oil requirements, mostly from the Middle East. When global supply chain disruptions push oil prices higher, import-heavy nations suffer. But when you multiply that expensive oil by a severely weakened local currency, requiring 61 pesos to buy a single US dollar, you get a compounding effect known as imported inflation. This chart visualizes the damage. Look at transport costs. They swung from negative 0.3% inflation to a massive 21.4% spike in a single month. Because the economy relies on imported fuel to move everything from people to agricultural goods, local consumers are trapped paying a double premium until global energy markets stabilize. There is a persistent belief that remittances from overseas Filipino workers provide a guaranteed shield for the peso. Families receiving dollars do see their local spending power stretch a bit further in the short term. Early in the year, those cash transfers actually grew by 3.5%, injecting roughly $3 billion a month into the economy. But this diagram shows why that influx isn't enough. That $3 billion in remittances is entirely swallowed up by the country's trade deficit, which hit a staggering $12.8 billion in the first quarter alone. The country buys significantly more goods from the rest of the world than it sells. That creates a massive, continuous structural demand for US dollars, keeping the peso pinned down. The second macroeconomic signal involves interest rates. In the United States, the Federal Reserve has maintained a strict, higher-for-longer monetary policy to fight their own inflation. High U.S. interest rates act like a global vacuum. They pull investment capital out of emerging markets, aggressively punishing riskier currencies as investors seek the high, safe yields of the dollar. To defend against this capital flight, the Philippine Central Bank executed a preemptive counterstrike, raising its key policy rate by 25 basis points to 4.5%. But with U.S. rates sitting at similar levels, that local hike doesn't offer enough extra yield to justify the risk for international investors. The local central bank is effectively outgunned by the Federal Reserve, leaving the peso highly vulnerable as global money continues flowing westward. All of this brings us back to the political noise. High-profile dynastic rivalries produce a tangible economic drag, directly impacting fiscal stability. When you combine spiraling inflation with public corruption scandals and an active impeachment trial, foreign investors apply what is known as an institutional risk premium, demanding higher returns to offset the political instability. When capital flight meets domestic chaos, foreign direct investment dries up. Without that external funding, economic growth stagnates and the currency lacks the support it needs to recover. Surviving a crisis like this requires abandoning emotional reactions and adopting a cold, calculated strategy. This is the Alpha Protocol. It means looking directly at the brutal mathematical realities of the market, rather than waiting for politicians to devise a rescue plan. Panic selling guarantees a permanent loss of capital. In a high-inflation, low-currency environment, data-driven positioning is the only viable shield you have. So what actually survives a 61 peso dollar? You have to identify assets that are structurally designed to thrive in these exact conditions. The first strategy is targeting dollar-earning exporters or specific business process outsourcing companies. When their US dollar revenues are converted back into a weakened peso, their local profit margins automatically expand. The second strategy involves seeking out deeply defensive consumer staples. You need businesses with the pricing power to pass those 7.2% inflation costs directly onto buyers without destroying overall demand. The market does not care about optimism. It only rewards correct positioning. The numbers are entirely visible. The only question is whether you are protecting your cash or buying into the